Hey, what's up everybody? Brian McCauley, your mortgage expert here. So are you looking to buy a house? You're looking for a way to tap into your equity. You can't sell your house first and you're looking to potentially utilize a bridge loan, or maybe you don't even know what a bridge loan is. Stick around. This video is for you. So there's a hot topic out there right now called a bridge loan. I hear everybody talking about it all the time. It's becoming more and more popular in a market where you've got buyers that are currently homeowners. They need to sell their current house before they buy a new one because they've got all this equity in their property and they want to use that equity for the down payment on the new one. The problem is, in a market like this, a lot of other sellers don't want a contingent offer, and so that buyer can't sell their house first and use the equity to do the down payment on the other one. So the solution to that is what's called a bridge loan, and I want to clarify a couple things on what a bridge loan is, how it works, who it benefits, and how it all ties together. First and foremost, a bridge loan is designed to bridge the gap between a buyer that needs the equity in their house for the down payment on the new one, but can't sell first. Let's give an example. Let's say you have a house that you own that is worth $800,000. You owe $500,000 on the mortgage, so you've got $300,000 in equity, right? You can come to myself, any other lender out there, and say, hey, I need a bridge loan. That lender will give you a second home loan against your current property for $100,000, $200,000, whatever it is that you need, as long as you have enough equity. And they'll say, hey, we'll take some equity out of your house. We'll give it to you right now. You use that money for the down payment on the new house. And then when you sell your current house, you pay off the original note and the bridge loan. So it bridges the gap between having a down payment and not having a down payment. Now, where a lot of people get confused is a couple things. So number one, you have to have the equity in your house in order to tap into it and bridge the gap when you don't have the liquid and you're waiting on to sell your house for the equity for the funds. Number two is that bridge loan is a legal binding debt. So when you are buying that new house, and let's say you get a bridge loan against your equity for $200,000 and the monthly payment is $1,000 a month, the lender must qualify you with that bridge loan. So it does add debt to your debt to income ratio. It does make it harder for you to qualify because, again, now you've got another loan against that property. So the pro is you can use the equity, get the bridge loan, make the down payment on the new house, and get the payment and the structure and the rate that you want. The downside is you have to qualify with that additional bridge loan debts. A lot of times when realtors or buyers will talk to me about bridge loans, they think it's just like a separate loan, like a private loan, like, hey, we'll give them a private loan, they buy the house, and then they sell the house later. They call that a bridge loan, but what it really is, it's a second loan, almost like a home equity line of credit, a second loan against the equity that they currently have now to bridge the gap of the down payment. So people are starting to utilize it because they don't want to do minimal down. You know, they can't sell their house first. They don't want to pay PMI, so they will basically take the current equity that they have now, get a bridge loan, use it for the new property. So a couple things around that. Number one, these bridge loans take a little bit of time to close. I would say about 2 to 3 weeks, because you have to build that into the process, into the timeline. The second piece about that is historically, lenders are pretty conservative on the appraisal. So if you notice in the very beginning of the video, I said your house is worth $800,000, you owe $500,000. Well, these bridge loan lenders, a lot of times are pretty conservative on their appraisals. So if your house is worth $800,000, sometimes they end up, $760,000, $750,000, which obviously can hurt some of the equity you can tap into and may not give you all the funds that you need to bridge that gap. The other piece is a lot of these bridge loan lenders use an automated model. So Zestimate is an automated model, right? It says, hey, this is an automated system. This is what we think your house is worth. Here's the projection of the numbers. Well, when it comes from banking and financial institutions, their automated model and all the data that they use to project what the value of the house is never on the high side. It's always on the low side. And the reason behind that is because they don't want to overstretch. They don't want to overgive you too much of a bridge loan or use too much of your equity, because in the event that their automated model was too aggressive and your value was actually too high, they may have overextended themselves to you, and you may not be able to sell the house to pay off the first lien and now the second lien with the bridge loan. So there's a couple things to think about there. The third thing is most bridge loan lenders will require the borrower to open up a checking or savings account with them, and then whatever money you borrow on the bridge loan, $100,000, $200,000, they make you deposit it directly into that depository checking or savings account and keep it with them. Bridge loans do have fees, they're not free. People say, well, that's kind of expensive. I don't want to pay $2,000, $3,000, $4,000, $5,000 just to get a bridge loan for 60 days so I can use my down payment in the other one. Well, the hard part is that you don't really have a choice. If you're borrowing money from somebody else to make something work on a transaction you don't have control over, you obviously have to pay them. The other thing you gotta remember about a bridge loan is it's a short-term loan. The interest rates are not very good. They're usually 12, 24-month terms, but you have to understand most lenders make their money off interest and on payments. Well, if you're only gonna keep that bridge loan for 30, 60, 90 days, right until you sell your current house and pay it all back, that lender's not making any money on the interest of the loan because you're only gonna make 1 or 2 payments. So what's the way they're gonna make their money on the transaction? They're gonna make it in fees. Just something you gotta be prepared for up front. I think bridge loans are super popular. I think they're a great strategy. You just have to know the details about them, which hopefully I've shared with you and you understand. And you have to make sure your current financial position, your strategy, structure, and the offer all lines up. But bridge loans are a great solution for anybody out there that needs them. So listen, hopefully you found this video valuable or useful. I'll try to give you guys some tactics and some tips. If you did, do me a favor, like, share, and subscribe. If you got questions about bridge loans or home loans in general, comment below. I promise myself and our team will get back to you. Or if you just want to connect with us directly to talk about your current situation, your home buying journey, mortgage questions, financial questions, reach out, call us, email us, text us. Just know we're always here to help. Until next time, stay tuned.